Hello, and welcome back to the Accounting Podcast, your weekly roundup of news in the accounting profession. I'm Blake Oliver.
I'm David Leary. Another week, Blake. You were traveling. I was traveling. We had a lot of email on phone, bad internet connections. It's lots of fun. But all my flights were good though. Everything on time.
You didn't get delayed due to the government shutdown, which has led to all these air traffic controllers calling in sick. I was in Atlanta and Boston, and my flight to Boston got delayed by a couple hours. And there was no official cause for the delay, but the flight attendants said it was due to the air traffic control in Boston. And I've been reading about this. Like, this is the, I think, biggest impact of the government shutdown on the general public, at least maybe the business community in general, is the fact that like these flights are getting delayed because there's not enough air traffic controllers in these towers. And, you know, the impact's huge. We'll talk about that. I also want to talk about this top story here, Deloitte and their AI Workslop. Well, that's what I'm calling it. We talked about AI Workslop in the last episode, or maybe it was the one before that. And that is work that is generated by AI that looks like real work, but turns out to be poorly done, inaccurate. It looks like work, but it isn't work. And Deloitte actually did like a government report for the Australian government using AI and got caught, and they had to refund hundreds of thousands of dollars. And what else? The IRS is shut down. That's a huge impact on accountants ahead of the tax deadline. Only 2 days to go as we record this. You've got a story about crypto going after CPA firm clients. I want to talk about EY's audit improvements. Lots of news to cover. So I really want to jump in and get to it. But first, let's thank our sponsors.
Our sponsors this week is Cloud Accountant Staffing, Rippling, and Assembly.
Thank you to our sponsors. And let's go ahead and thank Cloud Accountant Staffing here.
So did you hear the news, Blake? Cloud Accountant Staffing has now expanded beyond the Philippines, recruiting top talent from Latin America and South Africa. This means more options for your firm, including team members and time zones to better align with U.S. business hours, something that's crucial for many firms looking for real-time collaboration. Cloud Accountant Staffing was founded by a firm owner who grew his firm using offshore talent, and now he's applying everything he learned to help you grow your firm by helping you hire full-time team members for your firm from their global talent pool. How much would your firm change, or for that matter, your life, if you could add 40, 80, 120 hours of capacity to your firm in 2026? If your firm is in need of expert bookkeepers, accountants, CPAs, or virtual assistants, now with even more geographic options to choose from, head over to accountingpodcast.promo/CAS. That is accountingpodcast.promo/CAS.
Thank you, David, and welcome to our live stream viewers. If you have never commented before, comment today. Let us know what you think about these stories. Let us know what is top of mind for you. Give us your opinion. Give us your hot take. Welcome, Anthony. Welcome, Adley. All right, Deloitte is going to partially refund Australia for a report with apparent AI-generated errors.
And when you say refund, they're refunding a portion of a $440,000 payment they received. So they charged $400,000 for a report. Basically.
Well, this is yes, and that's the equivalent of $290,000 US. The Australian government paid for a report that was littered with apparent AI-generated errors, including a fabricated quote from a federal court judgment and references to non-existent academic research papers. This was reported by ABC News. The report was for the Department of Employment and Workplace Relations and was originally published on the department's website in July. And a revised version was published Friday after Chris Rudge, a Sydney University researcher of health and welfare law, said he alerted the media that the report was full of fabricated references. It's a 237-page report. Deloitte has confirmed that some of the footnotes and references were incorrect.
But they said that their findings and recommendations are still the same. So even though they went back and disclosed it and amended the report, nothing changed in their findings, which is interesting. They're trying to justify, like, even though we were wrong, it was still right.
So here's an example of the error, though. And Rudge said he found 20 errors in the first version of the report. And the first error that jumped out at him wrongly stated that Lisa Burton Crawford, a Sydney University professor of public and constitutional law, had written a non-existent book with a title suggesting it was outside her field of expertise. And Reg said, this is the quote, "I instantaneously knew it was either hallucinated by AI or the world's best kept secret because I'd never heard of the book and it sounded preposterous." This is, I mean, I guess, David, how do you prevent this? How do you stop this? If you're a consulting firm like Deloitte, how do you ensure that your employees aren't just making stuff up?
I don't know how you can do that, but what went through my head is this the real risk of AI taking accounting jobs? It's not the AI is going to take the job away. What's going to do is clients are just going to say, F hiring a firm, I could just do that myself. And that's the real risk to accounting firms and accountants and jobs is clients are just going to be like, I could just do a half-ass ChatGPT 4.0 thing myself and just pump out a bad report. I don't need to pay somebody $400,000 to do it.
Well, I think it depends what you're using the report for. And if you're just using a report like to get a particular tax deduction and you just need the report and the quality of the report doesn't matter that much, I think that sort of thing is going to be easily automated with AI. And if you think about it, this is the risk to audit, which is, the core service of the accounting profession is if companies feel like they just need an audit to check a box, then they will have no problem using an AI auditor to do that job. So there's a big opportunity for technology companies to come in and use AI to automate audit and just hire CPAs to sign off on them at the end of the process and essentially take the ownership of that audit away from the CPA firms. And maybe it'll be a CPA firm that does it, right? But it's either way, it's not good for individual CPAs necessarily.
And this wasn't an audit. This was they were reviewing welfare compliance systems. So I imagine this was probably turned from a review to a consultant engagement on how to eventually implement a welfare compliance system.
They did say it was like an assurance type engagement, some sort of like assurance on this program. But I guess like the report that they generated, they did it with the AI and they didn't check all these references and sites. It's sort of like, they did their job and then they had to make the report. They used AI to make the report, and then there were additional inconsistencies, errors added into the report by using AI. So that's what you have to watch out for.
The liberty of this. You could say it's hallucinations, and it kind of is, but it's kind of not. It's just, if you hired an employee that had 21 PhDs, they would constantly just be doing stuff you don't want them to do. You want dumber AI. I will still insist on this. It's funny. Did you see the quote from the labor senator, Deborah O'Neill? She criticized Deloitte, saying the firm has a quote unquote human intelligence problem.
I like that. All right, let's talk about this government shutdown, the impact on the IRS. But first, let's talk about air travel, because this, as somebody who travels a lot and has been traveling to, it was 6 cities in 3 weeks for the Advisory Amplified Tour, this impacted me. And it worried me. Like when I was getting on the plane, I was thinking, what if there's a problem due to air traffic control? Like, are we putting our travelers at risk because of this? And I think the answer is yes. The scariest thing for me was hearing about how at Burbank Airport in Los Angeles, there was a point in time during this shutdown when the air traffic control was completely off. There was nobody working the tower. Now, when that happens, there is a backup procedure, which is that the pilots have to do their own air traffic control. So they get on a shared frequency, and it's like at an airport that doesn't have a tower, a rural airport, they have to like communicate with each other. There's no intermediary. So that not only slows things down because you can't have the planes getting as close together as if you have air traffic control, it also creates risk. Like there's a huge risk of these planes crashing into each other because they miscommunicate. And like that's the problem I have with this shutdown, is that it feels like the Trump administration takes everything to the brink And all it takes is one mistake or one unanticipated economic incident or an international incident to then take down the economy or crash a plane. So the actual impact of this can be quantified. Controller-related delays jump from a typical 5% to 53% as workers called in sick because they are being asked to work but without getting paid. Now, back in 2019, the air traffic controllers created chaos at LaGuardia, Philadelphia, and Newark, and that actually was the thing that helped end the 35-day shutdown because Trump backed down. And so, I mean, like, I feel like this will probably happen again. But if it goes on even longer, what are we going into? We're going into the like holiday travel season. We're going into Thanksgiving. Like, this could be truly chaotic and risky and scary. The U.S. Travel Association is estimating a $1 billion weekly loss to the travel economy. 750,000 federal workers total have been furloughed. Over 1 million are working without pay. TSA is another thing. Security lines are going to get long because TSA screeners, they earn on average only $51,000. So if they don't get paid, they are not paying their bills. It's going to create real problems for them. They're not going to come to work. They're going to go drive for Uber to pay the bills.
This is not, I did not observe anything when I traveled. I flew Monday and then flew home on Saturday or Sunday or Saturday, I guess. But I didn't see any, I was in JFK. I didn't see anything. I had no delays, thank God. But I am flying again this week, so I'll report back in if I have
all right. I hope it goes okay for you, David. All right. So let's now talk about the impact of the government shutdown on the IRS. For our friends who are in tax, this could create some problems. As of October 8th, nearly half of IRS staff have been furloughed, with only essential personnel retained to maintain limited core services. What is open and what is closed? Here's what's open. Electronic tax returns are still being processed. The October 15th deadline hasn't changed for extensions. Tax refunds are being issued on an automated basis, especially if you're using direct deposit. But IRS phone support and in-person assistance centers are closed or severely limited. So taxpayers are going to have long wait times or no response from live support. Paper returns, mailed payments, and IRS correspondence are not currently being processed. Processing is suspended until funding resumes. Audits, enforcement actions, IRS legal counsel, and the Taxpayer Advocate Service are mostly halted or delayed. And interest and penalties, however, continue to accrue on unpaid taxes. And the IRS expects all deadlines to be met regardless of the shutdown. 39,870 employees are being retained. That's about 54% of the pre-shutdown workforce. They are going to keep critical services running, but the other staff are furloughed.
Now, the staff that's still working, are they being treated like the air traffic controllers where we will pay you eventually, but you're working for free right now? Same scenario.
I think that's the situation. Yeah.
They'll get back.
So you're, this idea that like that we're forcing people or asking people to work and do their jobs without getting paid
for the government.
So you're for the government. Yeah. It's just like, it's unconscionable. Like, we should not be putting human beings in the line of fire like this. This like collateral damage is just awful. And it's bad for the economy too, because what's going to happen is these folks are going to have to pull back on their spending. And so we're going to see the numbers get worse in the economy as a result of this, most likely. Like I said before, there's a $1 billion impact on travel just because of this.
And if you're still going to
avoid traveling,
you're still going to put out all this money anyways and back pay the people. What is this actually accomplishing? I mean, it's a negotiation tactic in the end, but.
Well, so that's why Trump has done something that's unprecedented. He has started firing federal workers instead of furloughing them. Trump just fired over 4,100 federal workers. It's the first time in modern history that mass firings have happened during a funding lapse instead of just furloughs. And examples of the firings, they're across departments. Treasury, 1,446 employees were terminated. About 1,300 IRS workers were in that group. Health and Human Services lost 1,200 people. Housing and Urban Development cut 442 employees. And it's like, this has never happened before.
Well, there's even more precedent being set by the IRS in the Trump administration.
What's
I
that?
don't know if you saw, the IRS now has a CEO.
The IRS has a CEO?
CEO. So essentially what happened is they created a new role and appointed somebody to it, and they basically bypassed the confirmation process. So it's a new role called CEO of the IRS, and they filled it with the former CEO of FIServ. He currently was serving as the commissioner or overseeing the Social Security Administration. So they moved him over to IRS and created a whole new role called CEO. No hearing anything. Just he's now kind of, in a way, he's not the commissioner, but
he has the job of the commissioner.
He has the job of the commissioner,
title,
essentially.
So that way, during the government shutdown, they don't have to get confirmation.
And arguably, this is a complete conflict of interest. So I'm going to demolish his name. Bisigano? Bisigano?
You're going to have to spell that a little slower for
I'll
us.
do Italian style. Bisigano. There.
All right.
Longtime Republican donor.
Yeah.
He and his wife, they donated about $900,000 to the Trump 47 committee last October. He obviously got he became the commissioner of the Social Security Administration. But where the real conflict of interest happens here is he used to be the CEO of FIServ and still owns.
I think, don't people just say FIServ? I say FIServ.
FIServ. All right, FIServ. And he still owns about $300 million worth of stock there. Now, there's two other stories I have about North Dakota. So North Dakota just launched their own stable coin. Right? They call it the Rough Rider coin, based on Theodore Roosevelt. And they worked with FIServ to launch this. So it's going to be fully backed by U.S. dollars and used primarily right now for interbank transactions such as loan settlements and overnight lending. But FIServ is basically it's their coin.
Why do you call it FIServ?
I don't know, because I don't want to. So you just say FIServ. FIServ.
I mean, I don't know. Listeners, tell us, how do you say it? Do you say FIServ? It means financial services.
Services, exactly.
Right.
And they what they've historically done is a lot of banks, smaller banks, community banks, they provide turnkey out of the box software to run your community bank or your bank. So what they're doing now is they have their own digital asset platform, and they're hosting not only their own stablecoin on it, now they're hosting this new North Dakota stablecoin on it. But let's go back to, let's say the U.S. was going to create a stablecoin. What department would probably be in charge of that?
What department would be in charge of that? Treasury.
Treasury.
Yeah.
And he's one step below the Treasury. So he's the CEO of the IRS. He's right there. Like, this is a complete conflict of interest. This is why you have to have hearings. You can't just appoint somebody to a position.
That's right. Well,
he has vested interest to get his hands and help launch a digital stablecoin for the U.S. government and have his company serve it.
Well, if history is our guide, then this will all be eventually ruled unconstitutional by the courts. But we still haven't had a decision about tariffs yet, and it's coming, and it could totally blow up all of that. Let's talk about the budget. Let's talk about Doge, David. Remember Doge?
Oh yeah, that's the other thing. The new CEO of the IRS, he's a pro Doge guy.
Pro Doge? Because
he's a pro Doge.
I mean, I have some bad news. Doge promised $2 trillion in savings. And I think last time we talked about this, it was going to end up being maybe a few hundred, $1 billion. Well, government spending actually rose this year. Government spending rose $220 billion this year. For the first time ever, U.S. government debt payments exceeded $1 trillion. That's more than we spend on Medicare or defense. That means that for every $5 collected in taxes, $1 goes straight to paying interest. So basically, Doge accomplished nothing in the broader scheme of things. Now, the tariffs have brought in $195 billion this year, which is double the prior year, but they still only equal 3.7% of federal revenue. And 51%, half of our federal revenue, comes from individual income taxes. So there is zero chance that tariffs is going to make a dent in the debt or do anything to solve this fiscal crisis that we are headed for. So basically, Doge failed completely, and we are rapidly heading toward, yes, publicly held debt is already approaching 100% of GDP, and it's expected to surpass the World War II record of 106% in the coming years. So it doesn't look like the Trump administration or the Republicans are going to do anything about it. So that's where we're headed.
And this was the whole, like, this was ultimately why Elon Musk got so involved in government. He was so scared about the debt. He was trying to solve the debt, solve the debt, solve the debt.
It is an existential crisis. The debt could end America as we know it. This is how it's happened in the past.
Nations fall. Yeah.
Look to history. Nations fall. Britain lost its dominance as a global power due to the debt that it incurred as a result of the war. And Spain, same thing with Spain, when Spain ruled the world. Same thing with the Netherlands. And it just goes on and on. It happened to Rome. So that's not a problem, though, that we have to worry about today, David. Let's keep going. And let's read. Actually, let's thank our next sponsor. How about that?
I'll let you read that.
Rippling. Thank you, Rippling. Rippling is the all-in-one platform that unifies your client's HR, finance, and IT in a single system. Accountants, if your team is stuck juggling payroll, benefits, time tracking, and IT, margins slip away fast. What if all those systems actually work together? That's what Rippling does. One platform where adding a new hire automatically updates payroll, benefits, compliance, and laptop access. No more chasing tickets or wrestling with spreadsheets. Just more time to focus on higher value work. With Rippling, firms can turn workforce advisory into a recurring revenue stream. You'll give clients live visibility into labor costs, overtime trends, and compliance risks, while offering insights that shape business decisions. It's how firms move from reactive admin work to trusted strategic advisors. You protect margins and build stickier client relationships along the way. And to sweeten the deal, when you book and complete a qualified demo, you will receive a $100 gift card. If you're ready to elevate your firm's advisory practice and get a $100 gift card, head over to accountingpodcast.promo/rippling. That's accountingpodcast.promo/RIPPLING. Okay, David, where do we go next? Do you have a story?
Because I got to talk AI. I have two AI stories. Should we give the warning?
Warning.
We're going to talk AI.
Get your drinks out if you're playing the game. Yeah, let's talk about it. All right. What's your AI story? Because I've got one about search.
I have two. One I feel like is just a better story. We'll talk about that first, then we'll do the OpenAI story, buying a personal finance app. So a startup founder used Claude AI to detect a $2.1 million embezzlement by his co-founder.
$2.1 million?
Yes, by his co-founder. And it took about 18 minutes to do this. Essentially, what he did is he exported all the QuickBooks data, put into Claude, and asked one question: what's wrong with this picture? And then asked what pattern suggests problems, and then said to investigate everything that happened. So in 18 minutes, it missed things that internal audits and external auditors and the CFO.
You said it missed things. You mean it found things?
It found things. It found things that CFO and internal audits missed. Right?
Like what?
It found fake vendors that were paid on 23-day cycles, real vendors paid on 28-day cycles, random payment dates, a lot of like statistical things, like patterns in the numbers.
Oh yeah, yeah. When people use fake numbers, they statistically have like a different like signature than real numbers. I remember that from my my audit classes.
Or people subconsciously create Fibonacci sequences.
Mm-hmm.
So it's 8,000, 13,000, 21,000. You keep adding the previous two. Like
So
subconsciously, you're doing these.
yeah, yeah, yeah.
So it really detected the patterns. It determined that there were 17 fake companies all going to this other founder's personal accounts via shell companies.
Wow. So he was creating fake vendors and paying these shell companies.
Exactly.
What startup
And
was this?
I couldn't get the startup name. I tried to find it. I don't know what the
Where's the
startup
story?
was.
Where did you get this story from?
This was in techbullion.com. Now, here's the real story, though. What
Okay.
this guy is doing now, this founder, he basically created a series of other AI prompts. He has an embezzlement detector, a fake invoice finder, the shell company revealer. So he created like little AI prompts, and now he's selling these for $10,000. He has 47 clients now. So he's probably making more money on his AI fraud finder stuff than he is on his actual startup,
Wow.
whatever that might be.
All right. So okay. So I get it. So this is the founder who discovered the betrayal and decided to create the solution to detect it in the future. Wow. And this is by who is this? You said Uzair Hassan.
So he's basically selling AI
Hmm.
prompts now. So there's probably if he's doing these $10,000 per analysis, there's probably opportunity for accounting firms to pump out something and be like, hey, for $2,000, I'll scan your books and make sure your business partner is not screwing you. There's probably a business opportunity here for accountants that are listening.
Actually, yeah, like a quick like AI fraud detection type of engagement. I like that. That could be good.
But then it makes me think like, so Intuit, Zero, they're all launching AI to write collection letters. Like this is what they should be doing. Like detect real things and surface real issues in data files.
Hmm. Well,
Like, I don't need to know that Starbucks for $3, what the address of that Starbucks is. That's the kind of AI insights we get right now on a bank
right.
feed. Nobody cares.
Yeah.
Like
What's
detect
my
real stuff.
or a chatbot that tells me what my gross margin is?
Yeah.
Yeah. Here's my AI story, and this is from the profitable firm. AI versus search, what accountants need to know now. So, a lot of us have been wondering in the world of accounting for marketing, what is going to happen to search engine optimization now that people are using AI? And the profitable firm, Karen Rayburn, found basically summarized the findings of a Spark Toro study, a study on this, that found that only 20% of Americans are heavy AI users, meaning that they use it more than 10 times a month. So 20% are using AI frequently. 40% of Americans are using AI tools at least once a month. But what's interesting is that the people using AI the most, the heavy users, are using search engines more now as a result of using AI. So search engine use has increased. Googling has increased among that group. Why is that? I mean, I'm just guessing because the more research you do, the more Googling you're going to do, like, right? Like the more AI prompting you do, the more you need to like confirm or look up or something like that.
Well, that's what's interesting on the Google, right? It'll give you that AI summary, but it's kind of hard to like ask a follow-up question. So in a way, you just do a second search or third search. It's
Mm.
not like a chat. And maybe it is, but Google sucks at UI, so I don't even know how to get into it after I do my search.
So 95% of Americans still use search engines monthly. 86% are classified as heavy search users. So 20% are heavy AI users, but 86% are heavy search users. So it has not inverted yet, right? We still have search engines are dominant. AI has not taken over when it comes to how people find your firm or find a service provider. Now, will this someday change? I think so, but I think it's going to take a lot of time. Remember, when Google first came out, it took a long time for people to stop using the yellow pages and to start using Google. It took 20 years, really, for the market to change in that regard. When it comes to habits, human habits, changing behavior is really hard and takes a long time. But I do think
Yeah,
it will happen. So anyway, the point is that search engine optimization and having a website and doing all that stuff is still really important. And AI relies on that. AI goes out and finds it and synthesizes it and brings it back to the user. So you still need to have all that. I agree with that.
you need to have something that reads your website eventually.
Yes.
So, which is basically SEO. It's just you have AI reading it now instead.
Instead of a human going out and reading it. And yeah, it's actually going to be, this is why I believe that video content and audio content is really important for firms, because it's getting easier and easier to create the text content with AI. And so if you've invested a lot in creating a blog, if you've invested a lot in creating a lot of web pages for your firm, that advantage is going to shrink as smaller firms and other firms are able to create that much content also, thanks to AI. Like, they're not going to have to go out and...
Yeah, a brand new firm in a week could create as much content that your firm historically did in a decade.
Yeah, maybe not that extreme, but yeah, a lot, right? Like, I could be 10x. I could do what your firm takes months to do in weeks. So, or years. Yeah, you're right. So I think the key is to continue with the SEO, but also invest in like video content, because you can create a lot of video and you can basically create a lot of text from video, turning those transcripts into articles, turning them into resources. But also AI is going to prefer video, because AI will be able to detect AI video and will prefer human generated content, because that's what people ultimately want. They don't want AI slop.
Agree. But then what happens when the AI just suggests, you don't really need to even hire that accountant or the accounting firm. I'll just do the work for you. So did you see OpenAI is buying a personal finance firm now, or a personal finance app now called Roy?
I hadn't heard that. What is it? Roy?
So in general, right now, OpenAI has been on this mission to like buy more customer-facing things. So they bought Pulse, Sora, and then now they bought an instant checkout shopping cart type tool. But now they acquired Roy, ROI. It's an AI personal finance app. And I looked at it a little bit. I was able to find it because they shut it down already, but I was able to find some screenshots of it. It's just like using Mint or Quicken back in the day. It's a personal finance app. And the real ramifications of this is what happens if OpenAI buys Xero or one of these new AI GL startups. And this, because it's pretty clear based on that other article we just talked about with the founder using Claude to detect all these anomalies, like, could it just become the GL? Like, you don't even need a separate GL. All these accounting startups are building a GL. Can it just be your GL, be your accounting system? OpenAI has the opportunity to own that piece.
I mean, I'm sorry to disappoint you, David, but I don't think OpenAI has any interest in owning a GL, because they basically turned into a consumer app. ChatGPT is used more like by consumers than by businesses at this point. And so it totally makes sense they're buying a personal finance app, because people are asking a lot of personal finance questions. And OpenAI needs the context to answer those questions. So if you have your personal finance data, all your transactions in their app, they can then use AI to get insights from that data. It's going to be incredibly powerful. And you might think, well, that's a huge risk for wealth managers. It's a huge risk for financial advisors. But think about who's going to use these tools. It's going to be people who don't have a financial advisor or don't have a wealth manager, which is the vast majority of Americans. So OpenAI is using their technology in a really smart way. They're using it to reach a market that is underserved. And that's what I've always said accounting firms should do with their services, is use technology and use AI to roll out a service at a lower price point to a market that hasn't been able to afford it before, because then you're not competing with other firms for the same clients. You're competing with the status quo, which is they were doing it themselves or not at all. And that's how my firm worked. The reason that we were able to grow very quickly is because we provided outsourced accounting services at a price point that competed with freelance bookkeepers, not accounting firms. So our clients could get a level of service that they would normally receive from an accounting firm or a CPA firm, and they could get it at the price of hiring a freelance bookkeeper.
So how cheap do you have to make your plan? If I can get AI, Claude, or whatever, even if I'm on an expensive one, I'm spending $200 a month. Because that's the expensive plans, right? Approximately $150, $200 a month for some of those AI models, but many are just $20 a month. So I'm spending $20 a month.
Yeah.
Do you have to price some sort of bookkeeping services at $20 a month? Because I'm going to reflect back on something. I remember Hector Garcia said, and this is early days, maybe 24 months ago. Hector Garcia said something that stuck with me. AI is never going to do perfect accounting, but it's going to do it good enough. And for most clients, that profit and loss statement's close enough. I can file taxes with it. It's good enough. So do you need to offer a good enough service at your firm where not saying you cut corners, but you don't provide the perfect financials? It's good enough financials.
Yeah. We need to, when we design services that are standardized, is you start from the price and then you figure out what services you can provide at that price. You don't start from the services and then add the price to it. Right. So you figure out your target customer and you figure out what they are willing or able to pay for the services that they need. Like, they need an accountant, they need a tax return, right? What can they afford to pay? What will the market bear? And then design your services to be superior at that price point. And I think the problem is most firms go the other way, and they design the services around what they think that the client needs, and it's often way too much. And then they price it based on their own cost and not on based on what the client can pay.
Or what the market will support.
What the market will support. Yeah, and then they're like surprised why nobody wants it. Yeah. And often, like, you're right, we're offering way too much. We're doing way too much, right? Clients that just want a tax return done and want the books done to get the tax return done do not need monthly financial statements. So why do we send them? Why do we prepare them? They just need very, very simple bookkeeping. And I mean, the firms I see that are like serving those clients well are doing the minimum for them. Yeah.
Yeah. There's a obsession with the monthly close. And I think I tweeted about this. I don't think I've ever met a small business owner that cares about having their book, this monthly close concept. They care about having their books closed when they have to get a loan. They care about having their books closed when they have to, they're going to get acquired or there's some big business deal, or their books closed so they can run taxes. But this concept of like, got to close the client's books every month. Nobody cares. That's not what they're paying you for.
No. David, let's go ahead and thank our next sponsor. And it's Cloud Accounting Staffing. Again, thank you to Cloud Accountant Staffing. If you're still on the fence about whether offshore staffing is right for your firm, I get it. It's a big decision. Here's something that should give you complete peace of mind and remove all the risk. David, I don't know if I can say that. I can't remove all the risk or give you complete peace of mind, but I think this might help. Cloud Accountant Staffing just rolled out an industry-first guarantee that shows just how much they believe in their process. If you hire someone through Cloud Accountant Staffing and commit to following their proven success framework, using their battle-tested onboarding checklist, implementing their weekly scorecard template, and setting up regular stand-up meetings with your new team member, and for any reason it doesn't work out within 90 days, they offer a full money-back guarantee. Okay, I get it. So that's the peace of mind. You get your money back if it doesn't work out within 90 days. That's 90 full days to work with your new team member, integrate them into your firm, and see real results. That's how confident they are, not just in the quality of their talent pool, but in their entire system for making offshore staffing successful. Think about it. They're essentially giving you a risk-free trial to add 40, 80, or even 120 hours of capacity to your firm. In this labor market, that's an opportunity you can't afford to pass up. To take advantage of Cloud Accountant Staffing's 90-day money-back guarantee and finally solve your staffing challenges, head over to accountingpodcast.promo/CAS. That's accountingpodcast.promo/CAS. Remember when OpenAI did their big GPT-5 announcement, and I noticed
and you shared the video
charts.
and the graphs were wrong or something, right?
Yeah. They have this big announcement, and they had like hundreds of millions of people watching it, and they had charts on the screen that didn't make any sense. The y-axis and the numbers and the bars were like completely off. And it turns out that is actually more common than you think. 86% of major companies are using broken charts in their financial reports. I spotted
And
this
is
in
this
CPA
AI
Journal.
broken charts, or just we just make broken charts? Just
Well,
human nature.
given how new AI is, I'm assuming this is just like not due to AI. This is just due to like human error. When you have people making charts that like are not like connected to the data. Maybe it's you have a designer making a chart and nobody checks to make sure that the chart actually makes sense. This is a study of 50 S&P 500 companies, and it found misleading bar charts, pie slices that don't match their percentages, and hidden axes designed to exaggerate performance. The hidden axis thing is where you start at a different number than 0. So it makes things look better than they are, or usually better than they are. This was in cpajournal.com. That's the most common trick, is starting a bar chart axis above 0 to make small differences look dramatic. One company made their product look way more successful by starting their bar chart at 30 instead of 0. Of 1,584 charts reviewed, 12% had fatal flaws that completely misrepresented the underlying data, and some charts were distorted by over 100%. That's shocking to me. And it makes me wonder, is anyone actually reading these reports? We know that 10K filings only get downloaded an average of like a few dozen times. So I'm guessing that we're doing all this work as accountants to put together these 10Ks with all these charts. And the fact that like so many of them have errors and nobody's pointing them out indicates to me that like
Nobody's
these
reading
analysts, so who's reading the reports? And when I bring this up to, I don't know, people who are really passionate about like financial reporting, I bring up these problems like when I talk to Jerry McGinnis on the Earmark podcast, they say, well, no slight to Jerry, I love Jerry, but like I got to argue with you on this, Jerry. Jerry says that it doesn't matter. I believe this is what he says: is it doesn't matter that the reports are only downloaded a few dozen times because they're read by analysts, and the analysts are very carefully looking through the reports. But if they were really carefully looking through these reports, would they not be pointing out these?
If anybody, the analysts
issues?
should be the ones picking up on this. They should recognize this information. But it could be all for naught. Did you see Cracker Barrel? Are you familiar with Cracker Barrel, the restaurants?
Well, I saw they had this whole logo redesign that didn't go very well. Is that what
Yes,
you're talking about?
and it tanked their stock price. But it turns out almost all the anti-new logo stuff was all bots. So
What?
in theory, we have this perfect world where stock price is determined by the financial statements.
Right.
But the reality
Yes.
is we have a world where bots are doing fake social media against a logo change, and it caused the stock to have a problem. Like nobody's
So like
looking at
fake
the
accounts
financials.
on social media, fake accounts on social media are criticizing the change.
Most of the anti new logo stuff that happened for them was essentially bots.
Where
bot
did that
traffic.
come? Really? I guess you could prove it somehow by looking at the accounts and figuring out which ones are bots. That's crazy. So why were they doing this? Were they trying to drive down the stock price to like profit from it?
So
Is there a conspiracy here?
I had this story and I didn't bring it to the show because I didn't like you opened the
Wow.
door. That's why I just brought it up. Give me
Yeah.
a second to find it here.
No, yeah, if you can find it, that'd be great. In the meantime, I'll thank our last sponsor of this episode, and that is Assembly. Are you still juggling 5 different software tools just to manage one client? You're sharing contracts through DocuSign, sending files on ShareFile, collecting payments in QuickBooks, and your clients are constantly asking, where do I find that document again? Sound familiar? That's exactly why Assembly was built for accounting firms like yours. Assembly is a client portal and practice management system that brings together your intake forms, e-signatures, tasks, messages, files, and invoices, fully white-labeled to your firm's brand. With Assembly, you can put all of your onboarding and client management on autopilot, and even embed tools your clients need, from Calendly for scheduling to the IRS payment portal. Assembly gives your clients one secure login across entities, whether you handle their personal or business accounting. Simple, secure, and straightforward. Ready to elevate your client experience and streamline your practice? Sign up today and get a 14-day free trial. Plus, use code EARMARK for an extra $100 off any paid plan. To see why accounting firms are making the switch to Assembly, head over to accountingpodcast.promo/assembly. That's accountingpodcast.promo/ASSEMBLY.
So this was data that the Wall Street Journal obtained from a company called Peak Metrics. 44.5% of the posts on Twitter about Cracker Barrel on August 20th, that's when the new logo went viral, were posted by bots or likely bots.
Wow.
And it peaked at about 49% when the controversy was in like full, trending Twitter topic type thing. So it's funny, right? Like this affected the stock price, not the financial statements. So maybe nobody cares about your charts because nobody even cares about the financial statements.
Right. And that's my argument, is that because accounting has failed to adapt over the last 50 years to our changing economy, to this change from tangible to intangible assets, to this change from a manufacturing economy to an intellectual property and services economy, that is why financial statements are not being used like they used to be. And that's why you have social media and non-financial metrics driving stock prices. And we have to modernize accounting standards. The language of accounting is outdated. And it's not a matter of small tweaks. It's a matter of major changes that are necessary to make them useful again. Let's talk about EY's dramatic audit quality turnaround. Here's a feel-good story. EY expects to achieve its lowest U.S. auditing shortfall rate in 16 years, dropping to 9% or below in 2025. That's what they are projecting anyway. This would represent a dramatic improvement from 46% in 2022. So they had a 46% audit deficiency rate from the PCAOB in 2022, and then it went down to 37%, and they got it down to 28% the following year, and now they're aiming to get it down to below 10%. It was the highest efficiency rate among the big four firms for 3 years.
Now, how did they make these improvements, are they saying?
They fired clients. So they shed 132 public company audit clients between 2023 and 2025.
So it wasn't because of AI. They just got rid of the questionable clientele.
Well, they got rid of the difficult clients. Probably, I'm going to guess, that resulted in more capacity for their teams, which were not stretched to the limit and could then actually do proper audits. Go figure. So their competitors took on net clients. It looks like most of the clients went to Deloitte and KPMG, although we can't really tell, but like the growth numbers like indicate that, because EY lost 101 clients and Deloitte and KPMG together gained 104. PwC got 9. So EY used to be the market share leader, and now it's Deloitte. So it seems to be that, like in the past, EY was the market share leader. They had the most audits. They also had the worst audit efficiency rate as a result. Like there's this perfect, well, not perfect, but I mean, seems like to be a very obvious correlation between how many audits you do, how much staffing you have, and the quality of the audits.
You're only capable of doing so much. It's that. Do you want it fast? Do you want it quality, or do you want it cheap? It's that same.
You can get two. Pick two, right? Yeah. So I guess that's good news. But then my question is, well, will this just cause Deloitte's audit quality to drop now as a result? Like, have we actually achieved anything here? Or have we just shifted the bad audits somewhere else?
To somebody else.
Yeah, exactly. David, sounds like you have something to share.
Yeah. So I'm going to use this word crypto bros loosely. I would say anybody who pushes crypto or Bitcoin's a crypto bro. Let's just, it's a huge umbrella. I don't know what else to call them. Right.
Label them.
label them as crypto bros. So some crypto bros, and I'll be very specific, Whitnam Transition Advisors and True Vestments have launched the True Vestment Bitcoin Legacy Fund, aimed at helping CPAs or CPA firms, high net worth clients invest early in Bitcoin through a structured advisor-led vehicle. So
Wait, you
essentially,
said
they
early
want
in Bitcoin?
early, yes. Essentially, they want CPAs to sell Bitcoin, this fund for Bitcoin, to their clients. And they
Okay.
have three phases. And now follow me on these three phases and tell me what this sounds like to you.
Sure, sure.
Phase one, they're going to raise $150 million through a private investment targeting CPA's firm's clients. So, hey, CPA firm, you have clients that have money, get them to invest in this private investment.
Oh, no.
Phase two, they found institutional investors that will match the first $150 million that came in from phase one. And then eventually they're going to merge this into a NASDAQ registered entity that it's an existing entity, right? So basically, what is that? That's a SPAC, right?
Yeah.
So this just does not taste right? Like this is like total Ponzi scam. Like, but they're going to get it. But again, we've seen this over and over again. The crypto people keep exploiting
Dude,
accounting.
David, don't say anything. Don't say anything on the show that's going to get us sued. Okay.
Well, this
Looks
just
like,
doesn't.
looks like, not is.
Looks like okay, it is. But historically, remember when all the crypto companies would say they got an audit, even though never had an audit
Yeah.
from the firms? The crypto keeps trying to utilize the CPA. This is a brand thing, right?
Yeah.
This like protect the CPA's brand. The AI CPA should be like railing against this. Like, hey,
Well,
don't push crypto on your clients.
I mean,
That's going to roll up into another institutional layer and then eventually go into and it looks like a SPAC, is from what I can tell.
right. I mean, so to me, like maybe like everybody who knows me, I think knows how skeptical I am of crypto. And I think that, personally, like to me, it is inherently like Bitcoin is inherently worthless. Like I think it's worth $0. I would never buy it.
And that's
the
because
only
you don't
reason,
have a CPA partnering with them, creating educational materials for your clients. People like your CPA should partner here and
right.
provide you the education you need.
So to me, what this means is that the fact that you have an investment firm targeting CPAs to try to sell crypto investments means that we're nearing the end. Okay.
Yeah.
Like, because there is an end game for crypto. And the end game is where there is no one left to buy it, right? When there are no new buyers that want it, the price will begin to drop. And when will that happen? We've already exhausted the individual market. There are really no net new individual buyers of crypto. Everyone who wants it has already gotten it. So like the fact that firms or investment groups are going after CPA firm clients means they've exhausted all the easier ways to get those buyers.
And they're trying to compare this to, like you said, early Bitcoin. They're trying to compare today's Bitcoin prices to like buying the Dow at $900.
Yeah, right.
But let's go take a time machine, Blake. Let's go back. Do you know when the Dow was at $900?
Well, not $900, 900 points, right?
Yeah.
I don't remember.
And it was basically somewhere between mid 60s to late 60s.
Okay.
Right. Now at that time, the Dow 30, here's who was in the Dow 30. AT&T, Bethlehem Steel, Chrysler, DuPont, Eastman Kodak, General Electric, like Goodyear Tire and Rubber, companies that made things. There was if you invested in the Dow when it was at 900, you were investing in companies that actually created value. And like you said,
they made things. Yeah.
They made things.
Yeah.
And it's not speculation, right? They all had there was real businesses happening there.
Yes. They were creating value for customers. Yes.
But that's deceiving. If this is the people running this fund are using words like buying the Dow at 900, I'm imagining that's in their training materials. They're trying to get CPAs to say to their clients.
So they are creating the expectation of future returns, and that expectation only exists as long as there are future buyers of crypto that are willing to pay more than you did for it. And eventually that will end, and there are no cash flows associated with Bitcoin. Like you buy a share of General Motors back in the 60s, and it made things and it made a profit, and it passed that profit back to you as a shareholder in the form of
There was a
dividends.
risk that they would make bad cars and maybe they went under, but
Yeah.
the plan was they would make cars, sell them for a profit,
Yeah.
and you'd get money back.
Yeah. I mean, to me, it's like, it's no different. Like the closest thing is gold, right? You could say like Bitcoin is digital gold, but even then, I just think that you're better off just buying gold. So, yeah. CPAs, be wary. Exercise your professional judgment and independence and protect your clients. Let's talk about, I don't know, some other miscellaneous news here. BDO USA just announced its largest expansion ever, and they are merging with Horn in a deal that combines firms that are enormous. 2.88 billion and 271 million respectively. BDO says their employee stock option plan or stock ownership plan was key to making this massive deal happen. Wait, I just saw another story about BDO's ESOP.
Yeah.
What?
BDO's laying off employees because of the way they finance their ESOP. So they owe a company. They got a loan from Apollo Global Management, which I think is probably a PE company or capital.
That's the PE firm.
Company.
Yeah.
That's a PE firm, right?
That's how they finance this ESOP, huh?
So they took a $1.3 billion loan at approximately 9%, and they're getting it. They got it reduced by 1%, but this loan is putting BDO to their knees. They basically have laid off employees. They've paused non-essential travel. Right? They are doing cost reviews across all their tax, audit, and advisory units. Like this is now the question. What's interesting thing is there's a post from Junk Bond Investor. So apparently, the company that gave them loan, they were also shorting another company called First Brands, sorry. So First Brands collapsed after BDO gave Brands. I keep saying Brands. First Brands collapsed months after BDO gave them a clean audit. So, like, where's the independence here? So BDO has a client that the person they took a loan from is auditing. They're auditing a client.
Wait. Say how's it working?
Okay, or shorting. All right, so let's tie this together. Okay, so we have
BDO is auditing who?
First Brands.
And First Brands gets a clean audit.
First Brands gets a clean audit, but it collapses a few months later.
And the
BDO's
private equity
lender,
firm,
the private equity
Apollo,
was shorting that company that they audited. So I'm BDO. I audited a company that is being shorted by a company I took $1 billion loan from. Like, where's the separation of?
Where's the independence?
Independence,
there? Yeah. It's like there's so much focus on independence by the regulators on like the appearance of it. Like an auditor can't own one share of a company that they're auditing, or they can't have any business relationship.
You can't put CPA in your LinkedIn signature.
Right.
These are all distractions.
Here we have private equity buying accounting firms or loaning them huge amounts of money, and we expect these firms to like be independent. And it's how did we end up in this situation?
And what are actually here's let's tie this back. What is the fraud triangle?
Opportunity, rationalization,
and like financial pressure, right? Isn't that?
Yes.
Financial pressure. So this is being described as rising financial pressure, this high interest debt on BDO.
Right.
Right? Like all parts of the fraud triangle are here. Like they have the opportunity to possibly scratch the back of Apollo here. They have this financial pressure. This does not look good, and it does not pass the smell test.
In the live stream chat, Chris Kahn says this has all the hallmarks of conflicts of interest and insider trading. Chris also pointed out earlier in the show that bots now make up the majority of all internet traffic,
including half the conversations on tax Twitter, I would say now. It feels like.
Yeah, so this is why, like, I kind of gave up on Twitter recently. or X. I gave up on X recently, and Facebook too, because I felt like, how do you know you're talking to a real person anymore? I'd rather like message my friends who are real people than sit on the internet. And that's also what's going to destroy Reddit, is because there's all these bots now on Reddit that are contributing to these threads. And so if it's not human generated, it's going to be, you know, we don't know the motives. What are the motives of the people running these bots? All right, David, that's all the time we have for this week. We didn't get to a few things. I've got some mailbag, listener mail. Hopefully we'll get to that next week. The Tax Foundation, they weighed in on the outsourcing tax proposal in the Senate. Who knows if that'll actually happen, but it's interesting. I want to get their take on it maybe next week. There's a study from Accounting Today about how accountants are ready for AI to replace people. Not a study, a survey. India wants to create their own Big Four. That's interesting.
Wow, that's...
Yeah, so next time, don't let me forget about that one. And good luck to our Tax Pro listeners. Good luck as we approach that October 15th deadline. If you're listening, it's already passed. Hope it went well for you. And let's all hope that this government shutdown ends and that sanity prevails sometime soon, because I don't really want to get on a plane anytime soon. But David, best of luck to you, and come home safe next week. Thanks everyone who joined us live. Great to see you all. Chris, Idiot Carrot, Boring Accountant, Stephen, Edgar,
Idiot
Emil,
Carrot's
Mohammed.
my
Idiot
secondary
Carrot.
screen name.
Idiot Carrot. Anthony, Adlai, great to see you all. Thanks everyone who joined us live, even if you didn't comment. We'll see you around here next week. And don't forget, you can earn free continuing professional education credit for listening to this episode and every episode of the Accounting Podcast. Get the free Earmark app. Download it on the App Store or the Google Play Store, or just go to earmark.app in your web browser, create a free account, register for a free course, and get a free CPE. Did I say free? Did I mention free?
Free.
Free. It's free, David. Free.
Just
CPE.
like TurboTax, free.
And if you want to support our work here on the show and at Earmark more broadly, subscribe for the low price of $169.99. We should have made it 69 on both. Why didn't we do that? No, you can't do it because it's the Apple. 6.7. We should have made it 6.7. 6.7. If you don't know what 6.7 refers to, it's the new 69.
You obviously don't have a teenager.
You don't have a teenager. All right. That's all I got this week. David, great chatting with you. We'll see you all around here next week. Bye, everyone.
All right, bye-bye.